Hi everyone, welcome back to Corporate Decoder, the place where we spill the tea on corporate filings. And let me tell you, Mr. Car Wash has spilled quite a bit this time. Get ready because we're diving deep into their latest quarterly report, and it's got some interesting numbers that tell a pretty clear story. Before we jump into all the juicy financial details, if you love getting your hands on clear, easy to understand business insights, make sure you hit that subscribe button. And hey, we've built a fantastic community over on our Discord server. Check the link in the description if you want to chat about these reports and more. Scroll Mr. Car Wash Inc. and Consolidated Statements of Operations and Comprehensive Income scroll. Kobio, first up, let's look at the big picture, the income statement. You know, the one that tells us if the company is making money or losing it. For the 3 months ending June 30th this year, Mr. Car Wash brought in about $65 million in net revenue. That's up from roughly $255 million in net revenue. That's up from roughly $255 million in net revenue. That's up from roughly $255 million in the same period last year. So revenue is growing, that's good. When you break it down, their revenue increased by about $10 million. This growth seems to be fueled by more people joining their Unlimited Wash Club and also by adding new car wash locations. They added 31 new locations in total compared to last year. That's a significant expansion. Now let's talk about costs. For the same 3-month period, the cost of labor and chemicals went up to about $76.6 million. That's an increase of nearly $4 million. Even though they added more stores, labor costs and chemical expenses as a percentage of their total revenue stayed pretty flat at 29%. This means they're managing those costs pretty well, even with expansion. Other store operating expenses, they jumped up by about $9 million to $108.8 million. A big chunk of that is likely due to having more stores, which means more rent, utility, and maintenance cost. This category is about 41% of their revenue. General and administrative expenses, those are the costs of running the bigger company, not the individual stores, stayed pretty much the same at around $25 million. This is a good sign because it means they aren't dramatically increasing the cost to manage the whole operation even as they grow. In fact, as a percentage of revenue, it actually went down from 10% to 9%. That's efficiency right there. The result of all this is their operating income. This is the profit they make just from their main business operations before paying interest and taxes. For the 3 months ending June 30th, it was about $54.1 million. That's slightly down from $55 million last year. So even though revenue is up, profits from operations are slightly down. Then we have other expenses net. This is mainly interest payments on their debt. This went down significantly by about $5 million to $15 million. That's because they've been paying down their loans and also maybe getting better interest rates. Less interest expense is always a win for the bottom line. When you put it all together, income before taxes went up to about $39 million from $34.7 million last year. That's a solid jump. And finally, net income to profit after all expenses and taxes came in at $28.6 million. That's a pretty good increase compared to $22 million last year. This shows that despite those slightly lower operating profits, the reduction in interest expense really helped boost their overall net earnings. That's a clear win for the quarter. Scroll 6 months ended June 30, 25 net revenues scroll. Looking at the first 6 months of the year paints a similar picture. Net revenues jumped by about $32.8 million to $527 million. That's a 7% increase. General and administrative expenses actually decreased year over year by almost $5 million. This was mainly because they had some one-time cost related to refinancing their debt last year that they don't have this year. Total other expenses also dropped by nearly $6 million. Again, that big drop in interest expense is the main player here. And their net income for the first 6 months of the year more than doubled, going from $38.7 million last year to $55.6 million this year. That's impressive growth, showing they are indeed making more money overall. Scroll Mr. Car Wash Inc. Consolidated balance sheet scroll. To now let's peek at the balance sheet as of June 30th this year. This is like a snapshot of what the company owns and owes. Their total assets are around $3.1 billion. That's pretty stable compared to the end of last year. What's interesting is their property and equipment, the actual car wash locations and the stuff inside them. This category is booked at $880 million. That's a big jump from $81.14 million at the end of last year. This confirms they are investing heavily in new locations and upgrades. They also have operating lease right-of-use assets at $905 million. These are basically the value of all the land and buildings they lease. This is also down slightly, which suggests maybe some leases ended or they are optimizing their lease agreements. On the other side of the balance sheet, their total liabilities are around $2 billion. It's also slightly down from last year. Their long-term debt is sitting at about $80.49 million, showing a decrease from $909 million. That's good. They are clearly working on reducing their debt load. And then their stockholders' equity, the value belonging to the owners, the shareholders. It's gone up to over $1 billion from $998 million. This increase is driven by their profits and also by issuing more stock, mostly related to employee stock plans. Speaking of stock, the company has a massive 1 billion shares of common stock authorized. As of June 30th, they had about 320th million shares outstanding. Their additional paid-in capital is sitting at a healthy $846 million. That's a good chunk of money that shareholders have invested beyond the stock's face value. Scroll Mr. Car Wash in consolidated statements of stockholders scroll Tiglair. This section also shows us how the equity has changed. For the first half of this year, they've seen growth from stock-based compensation, vesting of restricted stock units, and the exercise of stock options. It also shows their net income being added back to retained earnings, really boosting that equity number. Scroll 6 months ended June 30, 2025, stock-based compensation expense scroll. Let's talk about stock compensation. They recorded about $13.3 million in stock-based compensation expense this year. This is a big deal because it's a non-cash expense, meaning it doesn't directly affect the cash in their bank account, but it does dilute the value of existing shares if the company performs poorly. Looking at stock options, they've got a whole lot of them. The time vesting options, the unvested ones, they have about 3.6 million left to be paid out over time. The fair value of these is also pretty high. And for restricted stock units, they have nearly 5.7 million unvested. The company is really using equity as a way to keep their employees motivated and invested in the company's success. Now, a quick check on commitments and liabilities. They mention ongoing legal proceedings, but they don't expect any to hurt them badly financial-wise. They also have insurance accruals and receivables, which seems like standard business practice for a company their size. An interesting point here is that Mr. Car Wash operates as a single business segment. This means they don't really break down their performance by different types of car washes or regions. They see themselves as one unified operation managed by their chief executive officer. Moving into management's discussion and analysis, they're clearly focused on growing their comparable store sales by getting more unlimited Wash Club members and improving how efficiently they run their car washes. They are also heavily focused on labor management, believing that good employees are key to their success. Their location count has grown to 522. That's up from 491 at the end of last year. They are aggressively opening new greenfield locations. Comparable store sales grew by 3.6% for the first 6 months. That's a decent increase, showing existing stores are performing better too. The Unlimited Wash Club or UWC program is a huge part of their business. They have over 2.2 million members now, which represents about 74% of their total wash sales. This recurring revenue model is a real strength for them. They also highlight adjusted EBITDA, which is a way to measure profit without certain expenses like interest, taxes, and depreciation. Their adjusted EBITDA is around $172 million for the first 6 months. That's up from $16.3 million last year. Their adjusted EBITDA margin shows they are efficient at turning revenue into actual operating profit. So what's my take on all this? Mr. Car Wash is definitely on a growth trajectory. They're opening stores, attracting members to their subscription service, and by paying down debt, they are making themselves financially healthier. The dip in operating income for the quarter is a slight concern, but the overall increase in net income shows they are managing their expenses well, especially interest. Their reliance on the Unlimited Wash Club is a strong point, but it also means they need to keep those members happy and engaged. The big increase in property and equipment shows significant investment in the future, which is generally a positive sign for a growing company. They look like a well-oiled machine that's expanding its reach. Alright, that's our breakdown of Mr. Car Wash's latest filing. What do you think about their growth strategy and those financial numbers? Let me know your thoughts in the comments below. If you found this video helpful, give it a thumbs up. And if you want to keep decoding corporate finance with us, make sure you are subscribed. Don't forget to join us on Discord for more discussions. Thanks for watching. See you next time.